if I'm earning $600,000 as a physician and I'm able to go buy a handful of properties that nets me $60,000 in cash flow that I don't pay tax on, well, now I'm earning $660K in total income, but my taxes haven't actually changed. So my effective tax rate has been reduced. My total taxes I paid divided by my total income. So the idea is, how do I increase my total income without increasing my total tax?
What if you could reclaim hours of free time each week, create legacy building wealth, and devote more energy to your passion projects without giving up on your career as a life-saving MD? Dr. Vikram Raya is a functional cardiologist, high-performance coach, and real estate expert, is here to give you the tools, strategies, and solutions you need to transform your life, unlock your limitless potential, and achieve greatness, all while freeing up your precious time. Welcome to Limitless MD. Let's dive in.
I deal with a lot of physicians. I coach and mentor them. They invest in my company's Viking Capital. And I really want to be an advocate for these guys. They're really smart. They work super hard, but they fall short in a lot of categories, one of which is keeping the money they work so hard for. What do you think are the common mistakes or the common sort of things that, like, it's almost like they have a bucket carrying a lot of water, but there's a ton of holes and all this stuff is leaking out. And I call it tax drag. What is causing all this tax drag, or sort of the loss of the wealth that they're working so hard for?
It kind of starts off because, like, when you have a job or when you have an active business, your income is basically earned income, and earned income is taxed up to a rate of 37%. And physicians and other medical professionals tend to be high income earners, so they get up into those high tax brackets where they're paying that 37% rate. Then they're also paying state taxes in many cases, maybe local. And if they're self-employed, you get that extra 7.65%. That for a total of 15.3% in self-employment tax. So you have a lot of tax that people are getting taxed on. And it's not the most efficient way necessarily to build wealth if you're looking at purely from a tax perspective. So the question becomes, okay, so if you simply do that, you're always going to be at this high tax rate. But the question is, what can you do to either, A, reduce your taxes, or B, start building an income that's more tax efficient? And that's when I think a lot of physicians, medical professionals, they start to come across real estate, because real estate, if you execute certain strategies, can help you reduce your taxes in some cases. And there's other strategies you can employ that can help you build more income, but without that tax drag. So in other words, you're able to shelter your rental income from tax. So you'd be able to add income, reducing your effective tax rate. But basically earning money more tax efficiently by investing in real estate.
Yeah, and if I can just add, what I've seen over my career is high income earners are sometimes earning so much money that they don't know what to do with it, so they just let it sit in their checking accounts. And I think that is ultimately, obviously hurts them. But I think that is a big problem when it comes to any sort of tax efficiency. What you really want to be doing is kind of what Tom said. You want to take that money and you want to roll it into assets that are going to produce income, and ideally assets such as real estate that are going to produce income effectively tax-free. Nothing's ever free, right? We're kind of kicking the can down the road, and we can get into that if we really want to. But if I'm earning $600,000 as a physician and I'm able to go buy a handful of properties that nets me $60,000 in cash flow that I don't pay tax on, well, now I'm earning $660K in total income, but my taxes haven't actually changed. So my effective tax rate has been reduced. My total taxes I paid divided by my total income. So the idea is, how do I increase my total income without increasing my total tax? And I think that is the main gap that we see with high income earners.
That I want to say that again, Brandon, because that's like a truth bomb right there. So boom. It's like it's not necessarily increasing income, because everyone can do that. You work more hours, do whatever, more things, but it's increasing income without increasing taxes.
Yeah.
And so that the more you can grow that delta, that's the name of the game. And then invest that difference and just compound that.
And I think it's really hard to visualize, especially if you're a high income earner, because it's like, okay, if I go buy $400,000 house $300,000, let's call it $300K house that cash flows $1,000 a month, compared to my down payments, my cash on cash return, that might actually be pretty good. But $1,000 a month, if I'm earning $700,000 a year, is not going to change my life. I'm not going to be excited about it, right? But the key is that if you bought 20 of those houses over the span of 5 to 10 years, now you're netting $20,000 a month. And that is something I can be excited about, especially if I'm not paying tax today on the net $20,000 a month, right? And then because like if you do that math backwards, like netting $200K a year, but not paying tax on it is effectively like having a W-2 job of what, $350,000,
Yeah,
right?
it's almost
So
like 1.5 times, right? The amount, or
yeah. So it's a slow build, and that's where I think a lot of high income earners get antsy. And high income earners typically look at that and they go, well, that's not something to be excited about, this $1,000 a month property. It's very hard to visualize what the future looks like. So then the next thing they do is they go, I want to eliminate my income today so I don't have to pay tax today. That's what they get all excited about. And that is where we've seen people get put into situations that are going to set them up for failure later.
I also want to talk about, hey, yes, it's all about tax efficiency, but it's also about growing the overall nest egg. So those 20 homes, yes, they may be getting $20,000 a month, but they can all appreciate in value. It's a hedge against inflation. I mean, your net worth is gonna explode because of all that.
If you look back over the past, I started this firm technically in 2015, but I netted like $4,000. So I tell people I started in 2016. So I started this firm in like 2016. So we've been at it for 6-7 years now, and we've only been in an upcycle. So all the real estate investors look like geniuses, but the ones that were doing cash out refinances all the way, I kid you not, these people added $10-20 million to their net worth. It's insane. So yes, you don't have to do that. That's definitely a more aggressive strategy, but we have seen people that have done that. And so then all of a sudden the cash flow, who cares? Right? Because now it's just an appreciation. I'm just running the market up. But the last 7 years have just been an insane explosion in growth for the real estate market. So you're exactly right. Yes, I've got the cash flow. The way that I look at it is the cash flow needs to cover the bills and give me a return. That way, any appreciation is not something I can count on. But man, if it runs up, I'm going to try to take as much advantage of that as I can.
That's awesome, guys. Let's talk about physicians in general. What are some good strategies for physicians to, one, protect their income? Like if there's a way for them to go from W-2 to either 1031 or K1, would you guys recommend that?
Yeah. So going from like a W-2 to a K1 or say like a 1099, for example. So I think that
1099. Yeah. I'm thinking 1031 from real estate. My mind is always, yeah.
I knew you were going with that. Basically, I think it depends on what their strategy is, right? What they want to do. If basically when you become self-employed, so you join a partnership or you start an S corporation, you receive a K1. Or if you go out and you strike out on your own and you work, or you work for different hospitals and stuff like that, you start receiving a 1099 on contract. You're going to be subject to the self-employment tax of 15.3%. So usually when you're working and you have a W-2, your employer's paying half of that amount, so 7.65%, and then you're paying the other half. So that's just something to note, that when you do shift over and you do make that transition to self-employed, you are going to have to pay that additional tax. So it's not either or. It's not like what's good or better. It's like, do you want to control your own destiny? Do you want to build your own company? Do you want to go ahead and do that? Then go ahead and jump into that self-employed bucket, right? If you're comfortable, you just want to go into work every day, clock in, clock out, do your job, take the money and go build wealth, then you might as well just stay W-2, because in that case, you're just not having to pay that extra tax. And when you're a high income earner, that does add up. It adds a little bit more to the amount you're paying. So I would say that it really just depends on what your goals are for your business and how you want to operate as a professional.
Okay, awesome. And then K1s, also like, is that more tax advantage than the W-2 or the 1099?
I would say for the most part, like just to keep it simple, I would say the K1 is about the same as a 1099. Like in terms of a tax, like it's both active income. You're still going to be subject to self-employment tax on either the 1099 or the K1 for the most part.
Well, hold on. I mean, I know that you're talking about active trader businesses, but let's also just recognize that it does depend on what the K1 activity is. Because if I invest in a real estate syndication or a fund, I'm going to get a K1 but that's very tax advantageous income at that point.
Okay, so to the listeners out there, we're going to make a really interesting distinction here. So when you get K1s, you can have it in an active bucket or a passive bucket, and that's what when I've talked to Brandon, we've had some of these discussions. So if I'm a owner of a practice and I own it with a couple other doctors, and I get a K1, that's considered active. Is that correct, Brandon?
If you are materially participating in that practice, yes.
Okay, and then what if I'm passively in, like we own a surgical center, but I'm not active with that? Is that considered passive?
If you are not materially participating in the surgical center's operations, then yes, you have passive income.
Right. So it's really, guys, how you define that K1. So you want to get into this more. You want to learn the details of it. And if it's passive, then technically, if you invest in something else, that can offset those passive gains if you are making gains. And so this is where the specificity and the technicality of the tax code is very important. It's good to have people of a high caliber who know this.
When you receive a K1, let's say that you are invested in surgical centers and you receive a K1, I believe that surgical center income is going to show up in box 1 as ordinary income on your K1. The mistake that we see tax professionals make is not asking clarifying questions about the activity. So what they'll do is they'll just take that K1, that box 1 information that says ordinary income, and they'll code it as non-passive, basically active income. But you might have been passive in it. And that can blow up your strategy because passive income can be offset by passive losses. So if your surgical center income is passive, then your rental income or your rental losses can offset that income without having to, jump through all the hoops of the passive activity loss exceptions like real estate professional status, short-term rentals, all that stuff. So it's really important to understand that sometimes tax preparers in the heat of the moment, they're just going to take a K1 at face value and they're going to make assumptions, but those assumptions might not necessarily be correct. So if you are, if you're materially participating, let your advisors know. If you're not materially participating, let your advisors know. You need to be talking to your advisors about each activity, each K1 activity, and how much you actually participated.
Thank you so much for listening to this episode of Limitless MD. If you found value from this episode, I encourage you to share this episode with a friend and let me know by leaving a review. For more information, make sure you check out the links in the show notes below or simply visit vikramraya.com. Until next time, be phenomenal.